Welcome back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC Readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have CARLISLE, I guess you can pronounce it, COS Inc., ticker is CSL, price at the point of filing is $218. Let me first say this is not recommendation, not advice. Please do your own diligence before investing into anything, and let's get right into it. Executive summary. Carlyle is a leading manufacturer of roofing products and building envelope solutions for the commercial construction market. It is an attractive business. It operates in a relatively consolidated market with rational competitors, and demand is supported by a high degree of replacement activity. An aging installed base of commercial roofs and increased demand for building efficiency that is driving increased content per building. It enjoys high returns on capital and generates strong, steady cash flows. And its building products business has been very resilient in past recessionary periods. You can defer a roof replacement, but only for so long. The company has increased its dividend for 46 consecutive years, increasing it at a 14% CAGR since 2011. Current yield 1.4%, and it has been repurchased at 2.4 billion in shares since 2017, reducing shares outstanding by 21%. The business sports a fine balance sheet with net leverage of just 1.4x trailing EBITDA, and its debt is fixed at less than 4% interest rates. The company has been on a decade plus long simplification journey, which has taken it from a mediocre, diversified industrial with 9 distinct business units to a focused building product platform that has generated attractive organic revenue growth, margins, and returns on invested capital. Today, their journey is almost done with only 10% of consolidated profitability outside of its core building products business. We expect management to divest its 2 remaining non building product businesses in the next 1 to 2 years, which, combined with its solid free cash flow generation, would generate close to $3 billion in excess free cash flow or excess cash flow, enough for CSL to buy back 25% of outstanding shares at current prices. Despite its strong market position and favorable demand characteristics, CSL is trading at a meaningful discount to its historical valuation, as investors believe the company is meaningfully over earning. We think profits will be more resilient than the market expects and believe that investors will re rate the stock higher as this becomes evident, particularly if the company is successful shedding its non core businesses. We would not be surprised to see shares trade 30 to 50% higher in that scenario. Company description. Carlyle Company (CSL) is a manufacturer of a broad range of products selling into commercial construction, aerospace and transports, and general industrial end markets. It operates 4 segments: Carlyle Construction Materials (CCM), Carlyle Weatherproofing Technologies (CWT), Carlyle Interconnect Technology (CIT), and Carlyle Fluid Technology (CFT). Its building product focused segment, CCM and CWT, accounts for 90% of profit, which with demand primarily related to commercial roofing and building envelope solutions through CWT, though CWT is more balanced between residential and commercial. The CIT segment sells connectors, sensors, and cable assemblies primarily into the aerospace and defense and industrial end markets, and the CFT segment manufactures adhesive and sprayers used in a variety of industrials and markets. The company traces its roots back to 1917 as Carlisle Tire and Rubber Company, focusing initially on rubber tires before branching into a more diversified enterprise with businesses serving a variety of industrial applications. It IPO'd on the New York Stock Exchange in 1960 and developed a synthetic rubber to enter into the roofing business a year later. Decades later, in 2008, the company launched its Carlyle Operating Systems (COS) based on Lean and Six Sigma in 2008 to help the company drive operational excellence and focus on its core businesses. This ultimately led to Carlyle gradually deconglomerating their operations, exiting businesses operating in trucks and trailers, tire and wheels, power transmission, and food service and braking, while simultaneously deploying capital to round out its capabilities in building products. Efforts over the past 10 years have helped drive attractive mid-single digit organic growth, meaningful margin expansion, and drove returns on invested capital from 13% to 22%. Carlyle Construction Materials, CCM, 59% of sales and 74% of EBITDA. The CCM segment is a diversified manufacturer and supplier of premium roofing products and technologies primarily for the commercial construction market. It has evolved from a supplier of single-ply ethylene propylene diene monomer (EPDM) roofing membranes in the 1960s to providing easy-to-install and energy-efficient solutions for customers. And its offerings include EPDM, thermoplastic polyolefin (TPO), polyvinyl chloride (PVC), and architectural metals and roof garden systems. Its products are sold together in warrant systems and separately in non-warrant systems to the new construction, re-roofing, and maintenance, and general construction and industrial markets. And its key brands include Carlyle Syntec, Versico, Weatherbond, and Hunter Panels in the US, and Resitrix and Hertelen in Europe. In FY22, the CCM segment generated $3.89 billion in revenues, 70% of which was for repair and remodel and replace markets, versus 30% for new construction. The vast majority of sales, 90%, are in commercial construction, with the remaining 10% into the residential end market. CCM has been benefiting from a strong re-roofing cycle in the US. Its products and solutions for non-resolution buildings are non-discretionary and can only be deferred for so long. Management expects the market to grow from $6 billion to $8 billion in the next decade, 3% market CAGR. U.S. commercial market. CSL generated $3.3 billion in sales to the U.S. commercial market, where it sells roofing systems, i.e., an EPDM or a TPO roof plus insulation plus fasteners plus adhesives. In general, EPDM is more common in northern, colder climates, while TPOs are more common in warmer climates, where its light refracting properties are most valued. Content per type of system is generally the same, though EPDM generally has a touch more. Management noted that EPDM growth is slower than TPO. CSL created the EPDM category and is the market leader with strong market share, while Firestone was a fast follower with its Elevate brand. Johns Manville also has a line. In TPO, CSL is a big player with mid 30% market share, while Elevate has high 20% to low 30% share. And both GAF, privately held, and Johns Mansell, owned by Berkshire Hathaway, have mid-teens percentage market share. In the insulation market, CSL competes with the other roofing suppliers in addition to a private company, Atlas. Architectural metals. The U.S. architectural metals business generates $300 million in sales for CSL, half of which comes from the residential end market. Management believes this business has a $2.5 billion TAM and is growing at 2x GDP. This business is closer to 50-50 new construction versus replacement. Europe. Carlyle generates $300 million in revenues in Europe, and this is much more fragmented market that management sizes at a $10 billion TAM. Carlyle Weatherproofing Technologies segment, CWT. 24% of sales and 15% of EBITDA. CWT is a leading provider of high-performance waterproofing and moisture protection products, protective roofing and underlayments, integrated air/vapor barriers, spray polyurethane foam and coating systems, and block molded polystyrene insulation for the building envelope. Its primary markets are the US and Canada, and the majority of its sales are through distribution. The business was created in 2022 following Carlyle's late 2021 acquisition of the Henry Company, and Henry is a best-in-class provider of building envelope solutions that control the flow of water, vapor, air, and energy in a building to minimize air, water, and energy loss. Henry accounts for $600 million of sales, 40% of segment revenues, and had 23% adjusted EBITDA margins as a standalone business, not including the $30 million potential benefit, 600 basis points benefit, from cost synergies to be realized by year 5 of the deal. Henry is 57% residential and 43% commercial, while repair and restoration is 52%, versus the new construction at 48%. The business increased sales by a 5% CAGR since 2007. Sales did decline 9% in GFC. Besides Henry, the CWT segment includes a spray foam installation business, 300 million in revenues, weatherproofing technologies, 150 million in revenues, and a variety of diversified building product offerings. Overall, the segment is more balanced between both non-residential and residential and new building/remodel. A key growth strategy for this business is to bundle products with its CCM business to be a full service provider from the foundation all the way up, known for creating value-added solutions that save customers time and money. Carlyle Interconnect Technologies, CIT. 13% of sales, 7% of EBITDA. The CIT segment manufactures sensors, connectors, cable assemblies, and complex harnesses for use in commercial, aerospace, military, defense, electronics, medical device, industrial, and test and measurement markets. The business over-indexes to commercial aerospace and saw its sales decline from 973 million in 2019 to 688 million in 2021 and 845 million in 22. While its EBITDA pre-COVID was closer to 200 million versus 180 million in 22, companies most similar to this business include Amphenol, 16x EV forward EBITDA, and TE Connectivity, 12x EV forward EBITDA. Carlyle Fluid Technologies, CFT, 5% of sales and 3% of EBITDA. The CFT segment manufactures and sells liquid, powder, sealants, and adhesives, as well as high-pressure foam equipment and solutions for spraying, pumping, mixing, metering, and curing automotive, industrial, transportation, wood, and protective coatings. The company acquired this business from Graco in 2014 for 590 million, as Graco was compelled to sell this business by the FTC in order to complete its acquisition of ITW's liquid and powder finishing business. Graco, 17x EV forward EBITDA, is its primary competitor, as well as Nordson, 16x EV forward EBITDA, industrial coating business. Valuation. At $218, CSL is trading at a 10.3x forward earnings and 8.5x forward EBITDA, both discounts to its historical averages, while its trailing FCF yield of 7% is also a discount despite being depressed by 500 million of increased working capital over the past 2 years. Notably, building products peers trade at an average forward PE and EV EBITDA multiples of 14.5x and 10x respectively. While the market clearly believes earnings are not sustainable, our opinion is that the market is overly discounting cyclicality and expectations that industry pricing will correct after surging input costs lead to meaningful price increases the past few years. While these factors will weigh on revenues, the impact will be less meaningful to profits as the company benefits from favorable price/cost dynamics with commodity deflation. Notably, EBITDA for CSL's construction materials business was flat from 2008 to 2010, despite a non-res construction spending declining 31% over the same time frame. EBITDA increased slightly during COVID. See upside from SOTP value bonus potential if they divest non-core businesses to become a pure-play building products company. On our numbers, CSL is trading at a 20% discount to its sum of the parts value. However, with Carlyle shares trading at a discount to its historical valuation and versus peers, we think management has an opportunity to divest its non-core business and use the proceeds to buy back shares opportunistically. On our numbers, CSL should or could generate as much as $3 billion of excess cash flow this year, enough to repurchase 26% of outstanding shares. Sale of CIT, 1.4 billion, 12x 22 EBITDA. This business is under earning due to still feeling the impact of COVID. It isn't not worth an APH multiple 16x, but a company like Amphenol could potentially pay 12x for this business to beef up a cyclically depressed end market consistent with their strategy of acquiring to maintain diversification. Assuming APH could drive margins towards their consolidated average at 1,000 basis points versus CIT, returns would be in line or better than their historical experience. Sale of CFT, 700 million, 12x 2022 EBITDA. This CFT business was purchased in 2014 for 11x EBITDA in an all-cash transaction worth $590 million. Notably, the deal was forced by regulators so that Graco could complete a large transaction with ITW and satisfy competitive concerns. We think a 25% haircut to Graco 17x and Nordzone 16x is appropriate here. Excess cash flows. Carlyle historically converts 100% of net income into free cash flow. On consensus earnings, CSL is expected to earn $1.1 billion in profits, assuming historical conversions and the payment of $130 million of dividends. CSL should generate a little under $1 billion in excess cash flow in 2023. Once the divestitures are complete, we think the company would receive a valuation more in line with building product peers. At a 10x multiple with divestiture proceeds and cash flow utilized to buy back shares, we see almost 40% upside from current levels. Catalysts: continued execution, divestiture of non-core business lines. Thank you very much for tuning in, and see you next time. Please write down in the comments below what you think of this idea.